What's going on, everyone? I've got some good news for buyers this week in today's short market update, so let's get started. Hey, thanks for joining me today. I'm Rick Harrison with MVP Realty in Southwest Florida, and on this channel, I bring you the latest market news so you can make better decisions when it comes to buying, selling, and investing in Southwest Florida real estate. If you're new to the channel, welcome, and if you haven't already done so, please consider subscribing and hitting that bell so you don't miss out on the latest data, tips, and news keeping you ahead of the market trends. While it's only been a couple days since my last update last week, I've got some stats that are good news for buyers and a couple macro stories that show that inventory levels may be turning a corner. So let's start off with the local 7-day market data. All right, so let's dive right into our 7-day market update. Please bear in mind, though, this is from 3 days ago. So these changes are not actually a week over week, but rather a 3 days previously, a comparison to those last 3 days. So the numbers will be reflective of that. Just keep that in mind. New listings, we went from 971 3 days ago to 912 this Monday. So that's actually down 7% from 3 days ago. However, if I was to do a comparison week over week, I think we would see that we are actually still increasing in new listings. Um, Moving on to solds, we went from 910 a few days ago to 960. So that is up 5%. Again, this probably wouldn't be too much of a change if I compared it to week over week. But you'll see both of these stats reflected in the new listings inventory breakdown in the next slide when we go over that. Pendings went from 1015 to 1014, really no change there. And again, no surprise, price decreases went from 606 just a few days ago to 671. So just in 3 days, it went up 10%. That's quite a significant change. And I think you'd also see the pendings have decreased over the last 7 days as well if I did that week over week comparison. All right, moving on to the current inventory breakdown. Single family homes went from 3108 last week, just 3 days ago, to this week, 3213. So that's up 105 new listings in just the last 3 days. As well as condos moving from 1554 last Thursday to 1609 this Monday. So over the last 3 days, we've gained another 55 condos there. We went from 468 total new listings in our last market update gain to a gain of 160 in the last 3 days. That is quite a significant increase in the last just the last 3 days. Uh, Probably looking at doubling that, if not tripling that, to get to a week over week change. Moving on to multifamilies. Last week we are at 126. Just in the last 3 days, we've gained another 13, brought it up to 139 multifamily properties on the market. Foreclosures, we saw one new one come on over the last few days, so not much of a change there. Again, foreclosures have really not been a big story over the last 2 years or more. Moving on to interest rates, there is a big change in interest rates this week. We did see the interest rates decrease, courtesy of the 10-year bond going down over the last couple of days. So the interest rates went from 5.3 to 5.06, 1% according to Nerd Wallet, and then according to Bankrate, it went from 5.48 to 5.39. That's down 9 basis points. So that's also good news for buyers. However, just do keep in mind, obviously, the more affordable interest rates get for buyers, the more likely buyers are going to begin to enter the market again. So while that is a double-edged sword, it does make it more affordable for you as a buyer. It also makes it more affordable for buyers as a whole, which allows more buyers to enter the market as well. So if these rates do continue to decrease, which I said may be the case because I'm not sure if the Fed is going to be able to pull off as many rate hikes as they'd like. Again, the Fed really isn't in control of the bond market. The bond market is in control of itself, and the Fed kind of just follows along with the bond market. So if that 10-year yield really continues to fall, we may see mortgage rates continue to fall as well. So that's something to keep an eye out if you are a buyer considering in the near future. As we've been seeing over the last several weeks, the market is starting to shift in favor of buyers, albeit slowly. But for those of you that have been patiently waiting and are getting ready to make some moves, when it does fully shift, you might be interested in using our free home hunter service. We've already found several off-market deals for clients in the current market condition, and it's going to get even better as things continue shifting. So there's a link in the description to check it out if you're interested in learning more. Let's move on to our headline highlights. I have four stories for you this week. Three of them do have to deal directly with the housing market, so I don't want to. This isn't going to be a long update this week, but I do want to cover these stories just to make sure everybody is in the know. So the first one, historic housing shortage shows signs of letting up as sales decline. Many sellers are still seeking sky-high prices for their homes, even though mortgage rates obviously have been rising. But as a result, buyers are backing off, which is causing home sales to fall and the housing shortage to actually ease. So as demand continues to soften, more sellers will likely be forced to drop their prices in order to get offers. That's good news for buyers and should finally be able to bring more balance to the market. As you can see in this chart, this is actually reflective month over month and year over year. So the median sales price right at the top, 424,000 in April. That's a month over month, actually a month over month increase of 3.1% and a year over year increase of 15.5%. So not quite what Zillow was predicting, which I believe was 22 or 21% year over year. So that is down quite significantly, and that is falling faster than even Redfin or Zillow have been predicting. Homes sold seasonally adjusted, that is down 1.8% month over month and 8% year over year. So that is dropping fairly significantly as well. And then again, the third line, pending sales seasonally adjusted, that's down 2.1% month over month and negative 7.2% year over year. So all of those are good signs for buyers as far as inventory starting to return back to normal, as well as the fact that we're seeing the median sales price inclines or increases start to slow down quite a bit as well. So we're going to see that probably continue to level off as the year progresses. All right, moving on to the next story. Single family rental returns dropping as home price spikes outpace rent increases. So this has to do with investors who have been investing, whether you're a flipper or a long-term investor. These are the stories that will be affecting you and the stats that will be affecting you in the future. New single family rental market report, according to Adam, shows that profit margins on three-bedroom single family home rentals are declining annually in 2022. This report actually looks at everything as a gross yield, gross rental yield. So keep in mind, gross means that the expenses have not been taken out of those margins yet. So while they may seem like decent margins considering the market conditions, you do need to still factor in the expenses that any typical investor would have. The report shows the average gross rental yields before expenses on three-bedroom single-family homes purchased by landlords this year are decreasing in 72% of the counties included in the report. So the way they factored this is the latest yields are based on annualized 2022 gross rent incomes divided by median purchase prices in the first quarter of 2022. Most of the declines are less than 1 percentage point from rental yields in 2021. But the rental yields are dropping in about three-quarters of the markets where median home prices exceeded 250,000. Most of the yields falling below 7%. Meanwhile, gross returns are decreasing in two-thirds of markets where homes typically sell for less than 250,000, which are mainly located in the Midwest and South. And those returns remain above 8% in more than half of those counties, despite the price declines. I'm sorry, despite the declines. Retail sales are revised upward, strengthening our near-term outlook as housing activity continues to slow. So this is the next story. Retail sales and food store services increased 0.9% in April, while March's figure was actually revised upward to a 1.4% gain. So that is not great news for inflation, obviously. Industrial production, a gauge of output in manufacturing, utility, and mining sectors, that rose 1.1% in April. That's the fourth consecutive monthly increase, according to the Federal Reserve Board. Um, as well, going right along with that, existing home sales declined 2.4% in April. I covered that in one of my previous updates. That's the third consecutive monthly decline. Housing starts also declined 0.2% in April. Single family starts were down 7.3%, and multifamily starts were actually jumped up 15.3%. Whereas on the permit side, which is really showing you the future starts, single family permits declining 4.6% and multifamily permits falling 1%. So even though we've had a multifamily jump with starts in April, we are seeing the permits, which are future starts, falling. Also, the National Association of Home Builders, they have dropped their index 8 points to 69 in May, which is the Home Builders Index sentiment. So they are becoming more and more pessimistic about the current housing market conditions for future sales, which is why the actual starts and completions have been declining. Moving on to another story, the global food supply. Just covering really the main highlights of this story. Global food insecurity has reached levels not seen since the financial crisis of 2008. Russia's invasion of Ukraine did not start a food security crisis, but it did add fuel to the fire that was long burning, says Sarah Menker, CEO of Grow Intelligence, a global company that uses AI and public private data to predict food supply trends. Before Russia-Ukraine conflict began, the two countries supplied a combined one-third of the world's wheat exports and were in the top five exporters of corn. Coupled with that, the world has about 10 weeks worth of wheat on hand, she said. Um, some of the causes that are contributing to this, obviously, we've talked about a few of them. Lack of fertilizer. The fertilizer shortage significantly reduced crop yields for big suppliers like the US, Brazil, and Western Europe later this year and into next year, which she is saying that could severely impact global food security and inflation for 3 to 5 years at a minimum, she said. Global drought conditions is also another thing. Conditions for wheat are the worst they've been in 20 years around the world. Major bread baskets like the US and Brazil, the world's two largest exporters, are also experiencing extreme droughts. There's a cooking oil shortage. The price of palm oil nearly tripled in the last 2 years, and the world has lost 75% of sunflower oil exports to the war. The grain shortage is another thing. Russia and Ukraine accounted for a third of the world's wheat exports before the conflict began. And now we're seeing record low grain levels. Part of that is due to the next issue, which is the supply chain. Because of the war, it's really made it impossible to move any of Ukraine's harvested grain across its borders. Even if they did shift to rail, it would move less than 10% of pre-war flow, which is not enough to really make up for the difference. So moving on to the wall of worry, we have really just two updates, and they're the same issues, but two updates have come into the market in the last week. One is the Fed is potentially looking at more aggressive rate hikes. They're getting a little bit nervous now that Powell has secured his position. He's beginning to be a little bit more hawkish, it seems. So they're looking at potentially a forced recession of some sort, or and that's really what they've come out and said, is that they are trying to really curb consumer spending because it is still increasing, which I'm sure is really hard to do since inflation is forcing consumers to spend more and more money. Obviously, impending recession, global shortages, but the other one is the U.S. China tensions over Taiwan. Recently, our President Biden, accidentally said something that I guess he is walking back now. It kind of threatened China that they will support Taiwan with military force if necessary, if China does try to impose or invade Taiwan. But he did walk that back and instead is saying now that they will support Taiwan with military equipment if necessary to stave off the invasion. And then obviously the last one, consumer credit and unemployment. Those numbers will be coming out soon. We'll get the new unemployment numbers and see if those are coming up this coming week or two for the new month. And then consumer credit, that's something we just need to keep an eye on as we move forward. So, all right, I hope you guys got a lot of information out of this. Please let me know in the comments what your thoughts are on the food shortages. Are you guys starting to stock up? Do you think this is something serious to prepare for? I know there's it's kind of a touchy subject. Some people say, fear mongering is creating more issues in the supply chains and the shortages to begin with. And then you have the other side of the story, which is that people should have should be preparing and stocking up more than they are, and the mainstream media is not really talking about it as much as they should be. So please let me know in the comments, and I hope you guys stay safe, and I'll see you in the next video.